FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Momentous news yesterday. Fed Chairwoman Janet Yellen has her first press conference right after the FOMC meeting. A lot to digest for the markets. The Dow takes it on the chin. Here to talk about it, Joe Deaux, Street.com. Joe, welcome back.
Thanks for having me back, Kerry.
Always a pleasure. You know that. So what's the uptake? What do you think happened? What's the takeaway from her news conference?
You know, it was interesting. The markets, for once, got a Fed chairperson who gave them a specific time period on something. There was a question asked during the Q&A, the press conference, in which they said, in your statement, the Fed said that there were to be a considerable amount of time between the ending of tapering and the beginning of raising the federal funds rate. How long will that be? And she said, well, it's hard to tell, but probably something like 6 months would make sense. Well, the markets took a deep little plunge. They did, by the end of the day, kind of bounce off that plunge. So I think the plunge came because she gave a specific number. And so the market was able to price in what 6 months would be in terms of how much they figured they'd have to kind of sell off. But then I think, the smart money started to parse, this is her speaking in a press conference, and it's not written in stone. So there's nothing that says that Chairwoman Yellen and the voting members of the policymaking arm of the Fed would necessarily begin raising rates 6 months after they end the economic stimulus program. And so now I think, we've seen markets kind of tick higher today. There's a lot of different reasons for that. I think, at least in interviews that I had done, I'd spoken to an economist from Moody's yesterday, and he said, listen, it was probably a mistake for her to say an exact number of when they will begin to raise interest rates. But it's impossible for her to know that by the end of 2014, if the economy will be in a place where they can even begin to raise rates. So again, we go back to wondering, when will they raise rates? And obviously that is totally dependent on the economic climate at the time. And we still got to wait for the pace, of asset purchases to completely end.
Yeah. I mean, what do you think, Joe, if they started raising rates today, what would happen now?
I think you'd have a serious repricing in markets. The markets aren't anticipating any sort of rise in rates until 2015. That's a price that seems to be, at this point, somewhat being factored in. But if she suddenly started raising rates now, you'd probably see a Dow sell-off, S&P sell-off, just because there's still concern among investors as to whether or not this economy can really stand on its own 2 feet. Not without the asset purchases, but in a rising rate environment.
Yeah, and remember, a number of people have come out and said that the job of the Fed has been basically just to keep the stock market up. So if they stop doing that, it's going to lead a lot of people to wonder really what the function of the Fed is at all at this point.
Yeah, and I think that's kind of a fair point of people wondering what the function of the Fed is, maybe to kind of allay some of the fears or questions as to what the Fed's job is anymore. It was interesting that the FOMC decided to drop the 6.5% unemployment rate threshold as a trigger for when the Fed would begin to consider raising rates. And I think a lot of that has to do with a Fed that is seeing inflation, core inflation, run below expectations. They were looking for about a 2% beat on inflation, and right now we're still kind of a little bit under that. And so now you have a Fed that is realizing that it needs to focus on that second part of the so-called thresholds, which is the inflation rate, and is, of course, what the central bank has historically always considered its job, and that is keeping inflation constant at a reasonable pace, so that it doesn't heat up too much or that it doesn't go into deflationary period. At least a couple of the people I was talking to, they did say that dropping this threshold in the unemployment rate as a point to consider raising the interest rates is key to the Fed telegraphing to the markets that it is considering that we are below the level of inflation that the Fed feels is comfortable.
Well, also the unemployment rate has kind of become a meaningless statistic because we all know that it's not really accurately reflecting the true unemployment rate because we've got that structural unemployment built in now where people who have stopped looking for work are no longer considered unemployed because basically they're not considered part of the workforce, right?
Yeah, I think the Fed has finally come to accept that using unemployment rate as a major indicator for guiding its policy may not be what they want to do, and that's because, like you said, we've seen slow turnover and people getting back to work, and so they're dropping out of the labor force. We've seen people going into retirement maybe a little bit earlier than they initially had expected because it's been so difficult for them to find work, and it has come to the attention of many members in the FOMC that the unemployment rate isn't the same kind of unemployment rate that they could so consistently depend on. And that goes back to the points that you've made and that I had just mentioned. Well, when the unemployment rate no longer functions in the way that they thought it would when they initially put the unemployment rate threshold into place a couple of years ago, then the Fed has finally stepped back and said, listen, we do understand that there are multiple economic indicators that we must consider when we want to raise the federal funds rate, raise interest rates. And since that unemployment rate is not essentially being computed the way that they had expected it to, then they had to make a change. And this is not surprising. The Bank of England, Carney, decided that they were going to take out that threshold as well. And this seems to be kind of a consistent thing that central bankers, at least in the U.S., in England, and maybe in many other central banks now are considering, and that is that unemployment rates and the labor force, the recovery is not what we've ever seen before, at least in most people's lifetimes, probably since the recovery after the Great Depression, and that has really forced the Fed's hand in finally stepping back and saying, you know what, we're not going to have this threshold any longer.
And there's really nothing they can do about it. And I don't know if you caught this this paper that was published by the Bank of England about monetary policy, but it really created a whole stir in the blogosphere, and pretty much something I always knew, but evidently the rest of the world has been blind to it, and that's pretty much that money in circulation, for the most part, is created by bank lending. I don't know how people did not know this, but that when banks, through fractional reserve banking, when they loan money, they actually create money on their books because they take from their money on deposit, they simply create money by crediting. When a loan's created, if there's $1 million loan, they just create $1 million on the books effectively, thus creating money. And evidently this has created a stir in the blogosphere, like, wow, how did that happen? And we were taught this in economics in college, and evidently this is okay, and we can create as much money as we want, except when there's no loan demand, then there's problems, then you have deflation. That's what we're suffering right now, and this is what's leading the central banks to give up trying to control unemployment through monetary policy. It can't be done.
It's proven to be much more difficult than the Fed thought initially. It seems like. The Fed has said that they've made unemployment critical as a part of their focus in helping the economy improve because they understand that long-term unemployment has very devastating effects on the overall economy, whether it's here or in another country. And, I think unfortunately for the Fed, they've realized that they've pretty much done everything they feel like they can, and they haven't been helped on the fiscal side, so Congress hasn't really helped them. Congress has been far more stingy, if you will, with their own stimulus programs, and it's one thing that Ben Bernanke repeated every time he came out publicly. He would always say, we're doing about as much as we can, and the government continues to show that they can't work together to figure out some sort of, aid to monetary policy. And Janet Yellen continues to mention it. She mentioned it in her Senate and House testimonies, and it was something that she reiterated yesterday on Wednesday in her press conference.
Yeah, she never comes right out and slams the Congress and the president as saying, get the fiscal house in order, but it's an underlying theme in everything they do, isn't it?
Oh, yeah, absolutely.
So, hey, up next, we got some other things to talk about. Gold's getting slammed, and what about the underlying economy? On the financialsurvivalnetwork.com, we're talking with Joe Deaux of thestreet.com.
When your accountant wants tax-free income, this is what he does. Accountants know the law. They also know that any American could legally get paid up to 3 times per month, 100% tax-free. That's 36 tax-free checks each year. It doesn't matter what you make already. This simple strategy could work for anyone. Go to www.irsrevenge2.com to learn how. That's irsrevenge2.com.
FSN Radio.
Do you have Medicare or health insurance through your employer? If so, listen up. The healthcare reform wasn't written to save the healthcare industry or even to lower healthcare costs. Shoot, it isn't even designed to insure the uninsured. It's just a temporary political byproduct. Like a flat rock you step on in a swiftly moving stream, Obamacare is just a means to an end. Want to learn more about Obama's ultimate objective? Then you'll want to review our latest research presentation found on oclies.com. In it, a health expert and industry insider explains what you think you know about caring for your health is about to drastically change in 2014. Plus, he details the simple steps you could take to save thousands of dollars per year in health costs. It's free for you to preview at oclies.com. Don't waste time. What you don't know about the healthcare reform could hurt you and your family.
The Financial Survival Network. It's all about what's next.
And we are back. I'm Kerry Lutz on the financialsurvivalnetwork.com. We're talking with the Street's Joe Deaux. So the underlying economy, which is what we all live and breathe, Joe, not doing too good. We've got this intractable systemic unemployment. And even Keynes said in the middle of a depression, you don't raise taxes. And what is it the administration and the Congress do every time they have the opportunity? Raise taxes, right?
Well, I mean, we definitely did see some of the tax breaks that had been in place for, payroll tax and whatnot came back. They allowed for those to expire. We did see them raise taxes on the wealthiest in the country. One of the interesting things that some analysts have been looking at, are this possible rise in interest rates. And, when the interest rates do go higher, there's a question as to whether we will see, a dip of some sort. I was talking to one economist earlier on Thursday who said, hey, listen, we're historically, whenever we see rates rise, we either see a drop-off in stocks or we actually see some sort of pullback in the economy. And so I think maybe that might be the real concern.
Hey, and look, Obamacare is a mildly veiled tax increase as well, 3.4% on investment income, right? I mean, that's a tax increase as well.
Mm. Well, yeah, in terms of the taxes, I haven't really been talking to a lot of people right now who've been focusing so much on the increase in taxes. Smaller business owners obviously have been voicing their concerns about the new healthcare program that's been put into place. They say, right now we don't really know what's going to happen. There's a lot of uncertainties there. It doesn't look like that Congress right now is pushing for major tax changes, especially in 2014. This is a midterm election year, meaning everybody in Congress is up for re-election, and a third of the Senate is up for re-election. The last thing any of them want is to be the person who voted to raise taxes when they're trying to get reelected. So that might not be a problem that at least corporate and individuals are going to have to look at for this year, but maybe it could be a concern down the line.
Yeah, well, it's definitely hurting the economy, and it's just economics. As much as the Congress and the country would like to ignore it, the rules of economics always come home to roost, don't they, Joe?
Yeah, they definitely do. And it's one thing that, it's questionable, I think, in the eyes of a lot of investors and the market as to how many people in Congress are constantly keeping a pulse on the economy. I mean, it's difficult to say all of them are. Many of them, may lead in areas that aren't connected to the economy. And of course, as you know, that's why I have things like the House Financial Services Committee, and not everybody is on the House Financial Services Committee. And of course, Congress relies on them to consider legislation because they're supposed to be, the members on that committee are supposed to be the experts determining whether a bill is reasonable to put out to the entire House of Representatives. But it's difficult. I mean, if you're talking nearly 500 individuals who are voting on legislation day to day, and to ask all of them to keep a pulse on, hey, what's happening in the S&P on a daily basis, what's happening, with GDP every quarter. Should all Congress people be aware of these things? I think absolutely, but on a day-to-day basis, as much as you and I may follow the markets, some of them do have, different expertise. And of course, Congress, the reason we have the Federal Reserve, arguably, is that the Fed was created so that it could act immediately to financial problems. And it was because the powers that be knew that Congress does not act quickly. Legislation takes forever.
That's putting it charitably, Joe. Yeah, that's for sure. And really, the Congress doesn't act quickly, and sometimes they act wrongly. Sometimes they act right. They do the right thing for the wrong reasons, and more often than not, they do the wrong thing for the wrong reasons. And where does that leave us? I mean, the whole financial crisis, a lot of it was due to the Congress failing to act to rein in Fannie and Freddie. They had so many warnings, right? How many warnings did they have? And this concept of home ownership for the masses, whether they could afford it or not, right? It's just, it makes you shake your head in frustration and anger to look at what they've done.
Mm-hmm. Right. And the 2008 financial crisis was a very classic case of legislators and even central bankers reacting as opposed to being proactive. And of course, it's hard to say, how many times Congress or the Fed have prevented crises, right? Because if it never happened, then I guess we might never know. And on the other hand, it's like a lot of conservatives who I've talked to said, listen, we like all the too big to fail legislation, and Dodd-Frank, was critical to have this discussion and to and determine how we would, regulate the banks in light of the recent things that had happened. But at the same time, they question, well, was it good to put, the entirety of what we've implemented with Dodd-Frank in at a time when the banks were deleveraging and hurting already? And, I think most people I've spoken to say, yeah, something had to be done. But at the same time, you can understand that it, you suddenly decide to legislate after the fact, right? After the problem has occurred. It's always a really, really messy situation.
Yeah, and then
politically, I should say, yeah.
And then, of course, you have the case where all the people running these banks, that got us into this mess, they let them stay there. And the same banks that got us into this mess are still doing the same things. And then the derivative black hole keeps getting deeper and bigger. No regulation there. So, and of course, we go back to Glass-Steagall, and, Glass-Steagall was breaking down, of course, long before it was legislatively done away with. That's what many people don't want to believe and don't want to look at. But of course, I know and it was being systematically dodged and gotten around. But finally, they did away with it. So, but perhaps we needed a new Glass-Steagall that couldn't be gone around. And then the whole casino mentality, allowing the big banks to turn into casinos, but become casinos, federally insured casinos. That was kind of the ultimate denouement of responsible banking in America,
It was, obviously we look back and say, how do we allow for these institutions to be so over-leveraged, right? And it was kind of it was an example of what happens when you allow for investment banking, commercial banking to mix. A lot of people out there, of course, still calling for some sort of Glass-Steagall. It doesn't seem likely that we'll, really get it. Is it good or bad? I'm not so sure. The smart players, so-called smart players, still think that banks will have the ability to be two hands in two different baskets at once, and I think these discussions are ones that we're going to always have around, right? Even if, say, Glass-Steagall suddenly became law of the land again, we'd still be debating it. Is it really necessary? Maybe we're starving the banks. There's discussion on Wall Street already that Dodd-Frank is going to starve the banks, and hey, we haven't seen a meaningful change in, certain bank stock prices over the course of the past 2 or 3 years, and that's because of regulation. We can have those discussions, but there's always two sides to that discussion. Well, it's like I saw an interesting story that said, here's what the Consumer Financial Protection Committee, has done in terms of protecting individuals, right? And there's a number of good things that have come from it that people otherwise, could have been, scammed for, credit card protection. There was I think it was Citibank had to end up paying a fine of over $300 million for, basically charging people for credit card protection that they didn't even ask for. There's just so many. This is, Kerry, it's Wall Street. Yeah. It's incredibly complex. And for you or me, we get part of it. But, if you're asking the average person who's going to work day in and day out, 9 to 5, punch in, punch out, then they, got to feed a family of 4 or whatever. Even talking about the banks in the first place, beyond, hey, here's my checking account, my savings account, it's really difficult stuff for them to understand.
You're absolutely right.
And so it's always going to be a discussion that I think rightfully we will debate again and again and again. But to think that we'll have the correct answer one day, I think never we'll have the right answer. We'll never be able to please all parties.
Well, the problem is the average person is too busy trying not to go bankrupt today to be concerned about whether or not the local bank, too big to fail national bank, should be there or not, or whether or not they should be run by the same people that got them into the need to have a government bailout in the first place, right? Isn't that what it comes down to?
I think they don't. Yeah, they don't. They don't want the people who got them into the mess. This is why you definitely saw changes at the tops of the banks. Brian Moynihan essentially was a lawyer by trade. He's not necessarily a Wall Street guy the way that most people would think of it. And so, to say that they chose him because he was the next best guy to lead the bank, maybe he was, but at the same time, PR-wise, he doesn't look like the guy, one of the guys that had previously been kind of leading Wall Street. The guys that went out, they made money, they boosted, They boosted the top and bottom lines and value for stockholders and everything else. Instead, I'm using Bank of America as an example, right? But instead, you hire a guy who's kind of a lawyer who, it comes off as a bit more conservative, a bit more responsible. It's just little things like that. I mean, the culture of Wall Street's completely changed.
Yeah, you're right. But nonetheless, when they got risky stuff to do, they offshore it to London and keep their eyes closed, cross their fingers, and wait for the explosion. Wait for it to hit, right? That's the funny thing. It doesn't, the real risky stuff, they shoot off there, they place their whale bets and hypothecate off to London, and they hope for the best. Anyway, Joe, we got to run. Thanks so much. Street.com. You can catch Joe's work there. Always a pleasure, Joe. We'll talk to you again soon.
Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.